If you are an individual trader or a small business owner, tax planning is something that you probably don't pay much attention to. You have your annual tax return, and that's about it. You probably even pay an accountant to file your tax return for you. Well, one of the reasons for this is that it is not easy to understand. This video will try to take some of the mystery out of tax planning for small business owners and traders. Here are some tax planning strategies. Number 1. Defer or expedite income. On their books and tax returns, numerous small enterprises adopt the cash method of accounting. In accordance with the cash approach, a corporation recognizes income when it is received and expenses when they are paid, that is, when cash really changes hands. This creates fascinating tax planning opportunities. If you expect to be in a lower tax band the following year, you may wish to defer income until the following year, when you will pay less in taxes. When to postpone earnings. For instance, suppose you completed some work for a client in December 2021, but you have not yet invoiced the client for your services. If you wait until January 2022 to bill your client for the December work you performed, you can defer the income to the following year and reduce your tax liability for 2021. When to bump up earnings. On the other hand, it may make more sense to accelerate income into this year if you anticipate that tax rates will increase in the near future. In this case, you might want to send your client an invoice and try to get paid in 2021, so that a bigger chunk of your income will be taxed at your current tax rate. Expenses follow the same principle. If you are in a high tax bracket this year, you may wish to accelerate expenses in 2021 in order to lower your taxable income. When to accelerate or delay income and expenses is outlined in the following advice. Number 2. Depreciation of an investment property. The advantages offered by a property depreciation report are available to individuals and owners of small businesses alike who have rental properties in their portfolio. They are able to make use of the report to claim write-off deductions for their buildings, as well as the greatest amount of depreciation for their rental properties. Number 3. Private company loans, also known as DIV-7. Sometimes, proprietors of small businesses operating under the umbrella of a company will borrow money from their company. If they borrowed money from their company in the income years before this one, then they are responsible for repaying the principal, as well as the interest, during this income year. They have until the deadline to either fully repay the debt for the current income year, or sign on to a loan agreement. Either option is acceptable. If they don't, the money will be treated as a dividend that hasn't been taxed, as per Division 7. Tax planning for individual traders and small business owners is important to consider before year-end. The key is to plan for the tax implications of events that may occur during the year. Doing so will help you avoid potential problems and put you in a better position to take advantage of chances to lower your tax bill.